So today we are looking at partnership accounts. As I had told you before, that we are going to start on partnership accounts, and we are here with partnership accounts. That is our topic for today. Accounting for partnerships. That's our topic for today. So we are starting on accounting for partnership accounts. Accounting for partnership accounts. That's our topic. So our topic. So we are starting very soon. Okay. So our partnership account. Yes, good evening to you all once again. We are looking at partnership accounts today. And in this chapter, you will learn about the nature of partnership accounts and the regulations governing them. You will learn that there are two types of partners. We have what we call the limited and general partners. And we are going to see the difference between them and about the difference between those that are limited partnerships and those that are non-limited partnerships. So where you have questions, please, you'll use the chat box. Maybe you share the questions, or you can still raise, you can raise up your hand, and then you'll be able to ask your questions. Then we're also going to look at how do we prepare partnership ledger accounts and how do we prepare partnership financial statements. That's what we are going to be looking at in this chapter. Now, the need for partnerships. So far, previously, we have mainly concerned businesses owned by one person. But now when it comes to a partnership, you'll find that in a partnership, it's something different. The business is not owned by one person. You find that in a partnership, we have different partners there. So when a more permanent possibility exists, two or more people may form themselves into a partnership. This is a long-term commitment to operate in business together. These people who own a partnership are called partners. So what we need to understand when it comes to partnerships, that a partnership is where we see two or more people that come together. They agree to share the profits and losses of the business venture they have started. So here we see more than, we see an arrangement between two or more people who come together, they start up a business, but with the aim of making profit, So that is a partnership. So the key term here is partnership, and a partnership is where it's a business structure where two or more individuals agree to share profits and losses of a business venture. Now, those people who own that partnership, we call them partners. We call them partners. So partners are those people who own the partnership. So we refer to them as partners. They do not have to be based or work in the same place. I can be here in Uganda. You can be where you are. Someone can be in Mbarara. Someone can be in Juba. But we start up our business with the aim of making profits, though we are in different areas. So we don't need to be in the same place. Okay. However, they maintain one set of accounting records, and they have to share profits and losses according to their agreement. Now, there are various reasons for multiple ownership of a business. There are various reasons for multiple ownership of a business. Think about this for a minute, and then we write down as many reasons as you can for people wanting to form a business. Why partnership business? Let us try to find out the reasons as to why people go into partnership. Yes, Patricia, Susan, Aya, Kathy. What do you think are the reasons as to why people go for partnerships? Yes. Members, what are the reasons for partnership businesses? Yes. What reasons do you have as to why people want partnerships? Limited capital. Kathy is saying limited capital. Then what else, members? Let us try to list those points down. Let us try to list some of the points down. Why a partnership business? Someone is talking about limited capital. This is one. Sorry, limited liability. Is it limited liability, limited capital? Let me check again. Limited capital. Why limited capital? You need to elaborate more about that. Members, reasons for partnership businesses. Why would you go in for a partnership business? Realize more profits. We can say that maybe can say realize more profits. There are some main reasons as to why people go in for partnership business, even around the profits. Share, of course, improve decision making. So reasons as to why people go in for business. One of them, yes, Vivian.
Sharing of the loss and profits.
Sharing of losses and profits. Okay, we can say shared workload and responsibilities. Shared workload and responsibilities. So in a partnership, of course, we see that there will be division of labor. So there is a better work life. You share the workload, okay? You share the workload, improve decision making to have more capital. Thank you. So shared workload and responsibilities. Then the other thing is that the partnership is also easy to start, easier to establish, and it's less formal. Easier to establish and less formal. So it's very easy to start up a business when you compare it with maybe a company. It's going to be very easy to start up a business. The legal formalities are very few. The legal formalities are few. So it's very easier and less expensive to establish and less formal when it comes to the regulatory requirements. The regulatory requirements for partnerships they're not complex as such. So it's easier to establish and less formal. What else? Shared resources and capital. As someone talked about raising capital, shared resources and capital. Shared resources and capital. So there is more financial power. When we combine financial resources of two or more individuals, we can get a large pool of capital. We can get a large pool of capital. So there are shared resources and capital. We can get access to a large pool of capital because all the partners have to contribute in something. Then the risks are going to be shared as well. If there's a financial risk, in case you are making losses, these losses are going to be shared by the partners. So you don't suffer the burden alone as an individual. So the burdens are going to be shared. Then someone talked about decision making somewhere in the chat box. I saw decision making somewhere. We talked about decision making. That was who improved the decision making. That was Patricia. Okay. We can say enhanced decision making and problem solving. Enhanced decision making and the problem solving. Problem solving. Yes. So we have multiple perspectives. Remember, we have more than one individual who are going to be involved in the decision making, and this will lead to better solutions, of course, due to the different perspectives and insights from the different members. So that can also be an advantage. Then the flexibility. Talk about the flexibility. Partnership is flexible. Okay? Flexibility. How is it flexible? When it comes to partnerships, we can structure a partnership in different ways to suit the specific needs and agreements of the partners. So it's more flexible compared to a company. It's more flexible compared to a what? Compared to a company. So those are some of the reasons as to ETC. Of course, and many other reasons. These are some of the reasons as to why you may go for a partnership business. Shared workload and responsibilities, easier to establish and it's less formal. Shared resources and capital. There is enhanced decision making and problem solving. Partnerships are flexible. So those are some of the reasons as to why people may go for a partnership form of business rather than going in for a company. From there, what next? Now we need to understand the nature of partnerships. Partnerships have different characteristics which we need to understand. Okay, partnerships have different characteristics which we need to understand. First of all, a partnership is formed to make profits. We all know that a partnership is formed to make profits. The partnership is formed to make profits. A partnership must obey the law as given in the Partnership Act. A partnership must obey the law as given in the Partnership what? As given in the Partnership Act. Normally, there can be a minimum of 2. There can be a minimum of 2 and a maximum of 20 what? And a maximum of 20 partners. Each partner must pay their share of any debts that the partnership could not pay. If necessary, they could be forced to sell all their private possessions to pay their share of the debts. This can be said to be unlimited liability. So in a partnership, there is what we call unlimited liability. In a partnership, there is unlimited liability. So in the case of debts, failure to meet the debts of the partnership, the members are all liable. You will find that they are sale of their personal assets for them to be able to clear the partnership debts. So partners who are not limited partners are known as general partners. Partners who are not limited partners are known as general partners. So these are some of the characteristics of a partnership form of business. Those are some of the characteristics of a partnership form of business. Don't forget that however much these partners have unlimited liability, but in accounting, a partnership still it is a separate legal entity for accounting purposes. A partnership, it is treated as a separate legal entity. It's treated as a separate legal entity for accounting purposes. Yes, however much we see that the partners have unlimited liability, but for accounting purposes, a partnership is treated as a separate legal entity, meaning that the financial records of the partnership are kept distinct from the financial affairs of the individuals. Then don't forget that profits and losses have to be shared. This is another characteristic, that profits and losses are shared. Profits and losses are shared. So this is another characteristic. They agree on how they are going to share their profits. They will agree on how they are going to share their profits. Then maybe talk about the mutual agency as well. Mutual agency. When it comes to mutual agency, each partner is generally considered as an agent. If you're in a partnership, me, you, and all those others who are in a partnership, we are considered to be agents of the partnership. So we have the authority to bind the partnership to contracts within the scope of our partnership business. So everyone is acting as an agent if you're a member of the partnership business. So these are some of the characteristics of partnerships. Mutual agency, profits and losses are shared. A partnership is treated as a separate legal entity for accounting purposes. They are formed to make profits and so on. Now, we have two categories, or we have two types of partnership. There is what we call limited partnerships. We need to understand this. Limited partnerships. And there is what we call unlimited partnerships. There is what we call unlimited partnerships. I want to know, what is the difference between limited partnerships and unlimited partnerships? Who can explain this? Caleb, are you on limited partnerships and unlimited partnerships? What is the difference? Ian and Viola, Yvonne, limited partnerships and unlimited partnerships. What would be the difference between them? Who can explain this? Limited partnerships and unlimited partnerships. Anyone who can explain the difference between limited and unlimited partnerships? Neighbors? Anyone who can explain the difference between these two, limited and unlimited partnerships? Yes? Any trial? Susan, what is the difference between limited partnerships and unlimited partnerships? What could be the difference between the two? Anyone to try out? Yvonne, Richard, limited partnerships, unlimited partnerships. Any trial? Anyone to try? Now, when it comes to limited partnerships, now here the partners have limited liability. Under limited partnerships, the partners have limited liability. So here the point of distinction is between the liability. One we have unlimited, in the other one we have unlimited liability. So when it comes to limited liability partnerships, these are partnerships containing one or more limited partners. Limited partnerships must be registered. Yes, this partnership must be registered with the registrar of companies. Limited partnerships must be registered with the registrar of companies. Limited partners are not liable for the debts of the business. So in case of any failure to pay the debts of the business, the partners have limited liability. The partners have limited liability in case of failure maybe to meet the business debts. The partners here have limited liability. So that is limited partnership. that is limited partnerships. And you'll even find that under limited partnerships, the partners they do not participate in the day-to-day management of a business. Just look at it as a company. Okay, the limited partners do not participate in the day-to-day running of the business. You'll find that if the limited partner becomes actively involved in management, then they risk losing their limited liability status and could be treated as general partner. In fact, under limited partnerships, there can be general partners. There can be general partners under a limited partnership. There can be general partners. There can be general partners. Message in the chat box. Unlimited partnership will have full control over the business decision making. Yes, yeah, I see you have a question. You can ask your question. So unlimited partnerships is general partners, and then we also have limited partners. Limited partners. So general, these ones have unlimited liability. These ones have unlimited liability for partnership debts.
Yes, excuse me, sir.
Yes, please.
Yeah, looking at the business entity concept, it means that the business is supposed to be counted separate from the owners. So in this case, I'm looking at the partners as the owners of this business. So now when you say that the liability of that business will be on partners and it makes them limited partners, is it limited or unlimited? So something around there. Then I'm wondering how then is that that concept applied in this case?
Okay, let me explain more. Limited partners, these ones have unlimited liability. So, the unlimited liability means that your personal liability for the business, your personal liability for the business, for the business debts is limited. Is limited to the amount of the investment, limited to the amount of their investment, limited to the amount of their investment. Now, to go back to his question, he's talking about the partnership being treated as a separate legal entity for accounting purposes. Yes. If it's not a limited partnership, then one of the characteristics of partnerships is that the partnership is treated as a separate legal entity. Yes, however much it's not a limited partnership, but for the purposes of accounting, we treat the partnership as a separate legal entity. By separate legal entity, it means that we have to treat the partnership separate from the partners. That is for accounting purposes. However much there is no unlimited liability, for accounting purposes, we have to treat the partnership separate from its owners, meaning that the partnership financial records are always kept distinct or separate from the personal finances of the partners. That is what separate legal entity means. In fact, when it comes to accounting, all the forms of business entities are treated as separate legal entities. Even a sole trader, for accounting purposes, you're treated as a separate legal entity, however much you have unlimited liability, but for accounting, you are a separate legal entity. So even in partnership, if it's an unlimited liability partnership, then still, for accounting purposes, we view the business separate from its owners. So this is a limited partnership. We have general partners and limited partners. General partners have unlimited liability for the partnership debts. Limited partners have limited liability. Limited partnerships. For the unlimited, those are general partnerships, and all partners have unlimited liability when it comes to unlimited partnerships. All partners have unlimited liability, and that simply means that they are personally responsible for all the business debts and obligations of partnership under unlimited partnership. The partners are responsible for the business debts and the obligations of the partnership. So you'll see more characteristics of limited partnerships down there, but I'll try to elaborate more about that. Let us look at partnership agreements, because being that we are coming up together as a team, we are coming up together as a team, there has to be an agreement which we are going to follow. Okay, there has to be an agreement which we are going to follow. So that is the partnership agreement. You'll find that sometimes you have to hire a lawyer who is going to guide you on how to formulate an agreement. So let us try to see what is a partnership agreement and what are the contents of this partnership agreement. Now, agreements in writing are not necessary. The agreement should not be in writing. However, it's better if a written agreement is drawn up by a lawyer or by an accountant. So we should have an agreement. Where there is a proper written agreement, there will be fewer problems between partners. So if you have an agreement which we are going to follow, then we don't expect to see problems. If there's any problem, then we can resolve that problem because we have an agreement. Okay? Because we have an agreement. So partnership that has been agreed. Written agreement means less confusion about what has been agreed and what are some of the contents of the partnership agreement. What are some of the contents of the partnership agreement? Now, in the partnership agreement, the usual contents are the capital to be contributed, the capital to be contributed, the capital to be contributed by each partner. We have to clearly state that in the agreement, the capital to be contributed by each partner. We have to, that has to be clear. How much capital are we contributing? Then we have to also talk about the ratios in which profits or losses are to be shared. How are we sharing the profits and the losses? Okay, we have to also clearly state that in the agreement. Then the rate of interest, if any, to be paid on capital before the profits are shared. The rate of interest, if any, to be charged on partners' drawings. Salaries to be paid to the partners. We have to also talk about the arrangement for the admission of a new partner. If there is a new partner who wants to join, what are the procedures? Okay, what are the procedures? We have to also clearly talk about the procedures that are to be followed when we are introducing a new partner. Talk about the salaries, the procedures to be carried out in case one of the partners is retiring. We have to talk about all that in the partnership agreement. All those have to be clearly stated in our partnership agreement. So that is it. Those are some of the contents of the partnership agreement. They can ask you to explain like 2 or 3, 4 contents of the partnership agreement. So that is what we should expect to see in the partnership agreement. Then from there, we need to now talk about capital contribution. We need to talk about capital contribution. we need to talk about capital contributions. Now, due to the fact that we have agreed to come together as partners, we need to know how much are we going to contribute to capital. So if me, Kathy, Patricia, if we come together and we start up our business, we have to know how much are we contributing as capital. Are we going to be contributing the same capital, or we are coming up with a different capital shares? So we need to agree on that. So partners need with equal amount of capital. What matters is how much each partner agrees to contribute. What matters is how much each partner agrees to contribute. Not usual, it's not unusual for partners to increase the amount of capital they have invested in the business. So capital contributions, it's all about how much each of the partners is contributing. So we have to talk about the capital contributions in our partnership agreement. Then profit or loss sharing ratios. Profit or loss sharing ratios. How do we share the profits or losses? So partners can agree to share profits and losses in any ratio. So we can say that Caleb will take 4, assuming we have Caleb, we have Patricia, and then we also have Christine. Those are the partners in the partnership. So we can say that, okay, Caleb, you take 2, Patricia will take 3, maybe Christine will take 5. That is their ratio. That is the ratio which they are going to follow when it comes to sharing profits and losses. So in a partnership agreement, we have to agree on how we are going to be sharing our profits and losses. Are we going to be sharing equally or not? So we have to clearly set our ratios, which we are going to follow when it comes to sharing of the business losses or profits. Okay. Then interest on capital. Interest on capital. Now, when it comes to interest on capital, now due to the fact that I'm going to invest my money into the partnership business, how do I benefit? How do I benefit if I introduce my money into the business? I should be expecting interest on my money. I should be expecting interest on my money. So interest on capital, here we are strictly looking at the return on the capital that these partners have invested. Because if you invest your money, then you should expect a return. So if the work to be done by each partner is of equal value, but the capital contributed is unequal, it is reasonable to pay interest on the partner's capitals out of the partnership profits. Now, assuming I've contributed my millions of money, someone has just 100,000, then one has 500,000, but me, I've contributed 1 million. Now, how do I benefit from the capital I've contributed? So at least I should be getting some interest on the capital. Okay, that's why you see interest on capital. This is the return on the capital that the partners have invested into the partnership into the partnership business. Okay. So this interest is treated as a deduction prior to the calculation of profits and their distribution among the partners according to the profit sharing ratio. We are going to see how to deal with the interest when it comes to the accounting. The rate of interest is a matter of agreement. So the partners will agree on the rate of interest. Is it 10%? Is it 5%? So they will agree on how they are going to be paying interest and at what rate. Then we have interest on drawings. Drawings. When it comes to drawings, You know, people want to withdraw money from the business. Sometimes you may get emergencies. You want some money from the business. Now, if we don't charge interest on the drawings, do you know what happens? So the partner happens if members are just withdrawing every. So we have to charge interest. We have to do what? We have to charge interest. Because if you don't charge interest, then people are going to just be withdrawing money. So this interest can limit them from over withdrawing all the time. So it is all in the best interests of the partners in accordance with the two possible. Yes, we want to withdraw, but let us withdraw as little as possible. And let us withdraw as late as possible because the business needs cash. If that cash is just withdrawn all the time, then we may end up limited cash. Yet we need cash to support the activities of the business. The more cash that is left in the firm, the more expansion can be financed, the greater the economies of having enough cash. So we need the cash. Cash has to be there. If cash is there, then there are more chances of expansion and taking advantage of gains and not meeting cash discounts because cash is not available and so on. So to make sure that we have enough cash, we have to restrict on the drawings. We have to restrict on the drawings by charging interest on those drawings. So to deter the partners from taking out cash unnecessarily, the concept can be used of charging the partners interest on each withdrawal. So we have to charge interest on each withdrawal. When you withdraw money, we charge you some interest. Okay. Now partnership salaries. We on partnership salaries. When it comes to partnership salaries, one partner may have more responsibility for sure, or assets than others. So as a reward for this, rather than change the profit and loss sharing ratio, the partner may have a partnership salary. The partner may have a partnership what? May have a partnership salary, which is deducted before sharing the balance of profit, which is deducted before sharing the balance of profits. So we have to agree on the salary. If one of the partners is having more responsibilities, then entitled into a salary basing on then performance related payments to partners. Sometimes you find that there are some performance related payments, so we can agree on these payments. We can talk about this in our partnership agreement. There's some bonus to be paid. How much are we paying as a bonus partners? From there, let us now look at the financial statement. We need to understand the financial statement of partnerships because that's where now the aim is. That's where now our interests are. How do we prepare the financial statements? How do we prepare? How do we prepare the financial? How do we prepare the financial statements? That's where everyone is interested in to see how do you come up with the financial statements of partnership. Now, if the sales, stock, and expenses of a partnership were exactly the same as that of a sole trader, then the trading profit and the trading and profit and loss account would be identical with that as prepared for a sole trader. However, a partnership would have an extra section shown under the profit and loss account. A partnership would have an extra section shown under the profit and loss account. What does this mean? It means that the income statement of a partnership is the same as that of a sole trader, but there is just a slight difference. There is just a slight what? There is just a slight difference when it comes to the partnership accounts. So for a partnership, we have to add an extra section which we call we call that what? We call that the appropriation account. We call it the appropriation. We call it the appropriation account. We call that the appropriation. We call it the appropriation account. So this section is called the profit and loss appropriation account. So after getting your net profit, there is a section in which you have to add. That section is called the appropriation one. It is called the appropriation account. And it is in this account that the distribution of profits is shown. It is in that appropriation account in which the distribution of profits is what is shown. The heading trading and profit and loss account for the partnership does not normally include the words appropriation account. It will still be statement of profit or loss, but just down there, you have to add an extra section, which is known as the appropriation, section or the appropriation account. It is purely an accounting custom not included in the heading. Sometimes the examiner asks for it to be included in the heading, in which case you need to do so. So this is the format of the appropriation account. Members need to understand the format of the appropriation account. You need to understand the format of the appropriation account. What is the format of the appropriation account? So we start with our net profit. We start with our net profit from the statement of profit or loss. So we start with that net profit, as you can see. Then on that net profit, we have to add the interest on drawings. So assuming I have Taylor, I have Clark as the partners, I have to get their interest on drawings. I add their interest on drawings. We add them to the net profit. In the case there is any salary, then we have to less the partners' salaries. Partners' salaries are deducted from the net profit when we are appropriating those profits. Then interest on capital. The interest on capital should also be shown as a deduction. So these are deductions. The salary is also a deduction. Then we come up with a balance of profits to be shared. So that balance of profits to be shared, that is the profit that the partners are going to share according to their profit and loss sharing ratio. According to their profit and loss sharing what? And loss sharing ratios, as we are going to see later in the questions. After getting the profits to be shared, now that profit has to be shared. So you get the profit ratio times the profits to be shared for you to come up with a profit share of each of the partners. So this is what we call the appropriation account. That is the format of the appropriation. That is the format of the appropriation account. That's how we prepare that account. Net profit, add interest on drawings, less partner's salary, less interest on capital, get your profits to be shared, then you share them according to the ratios of the partners. Okay, now from there is something which we need to look at. That is the fixed and the fluctuating capital accounts. The partners have to prepare what we call capital accounts. But we have two types of capital accounts. We have what we call the fixed and the fluctuating capital accounts. I'm going to explain these two accounts, the fixed and the fluctuating capital accounts. Now, there are two choices open to partnerships. One choice is the fixed capital account plus a current account, and the other choice is the fluctuating capital account. Fluctuating capital accounts. Now, where partners use the fixed capital plus the current account, it means that they are going to prepare two different accounts. They will prepare a fixed capital account, and then they also prepare what we call a current account. Where they use a fixed capital account plus current account, means they are going to prepare two different accounts. That is the capital account and the current account. They will always specify the method the partnership is using. Is it current? Is it fixed capital plus current, or it is fluctuating? Now, the capital account for each partner remains year by year at the figure of capital put into the firm by the partner. That is the capital account. So that capital account records the initial investments. The capital account records the initial investments of the partners initially. And that initial investment is going to be the same. That's why we call it a fixed capital account. Unless maybe a partner has added in more capital. But if they have not added in more capital, then that balance will still be the same year after year, showing the contributions the partners made initially. Okay? So this is the format. Partners capital account. You show the names of the partners, details, names of partners. You put the balance brought down on the credit side. Since this is equity, so according to the rules of double entry, the equity or the capital account balance has a normal. The capital account has a normal credit balance. The balance brought down should appear on the credit. If there is any additional capital, you still credit and then you balance up the account. So this account strictly records the capital, please. Strictly for capital. The partner's capital account is strictly for capital contributions only. It is strictly for capital contributions only. That is, if the partners use the fixed capital plus current accounts, then the capital account will be strictly for capital. Now, where do we take the profit? Where do we take the interest on capital? Where do we take their salaries? The profits, interest on capital, and the salaries to which the partner may be entitled are then credited to a separate current account for the partner. So there will be a current account that is to be prepared also. The drawings, the interest on drawings are debited to it. So you see, under this approach, the partners will maintain two different accounts. That is the capital account, which records capital strictly, and then they will also prepare what we call the current account. So the balance of the current account at the end of each financial year will then represent the amount of undrawn profits. A credit balance will be undrawn profits, while a debit balance will be drawings in excess of the profits to which the partner was entitled. So meaning that current account can have either debit or a credit balance. If it's a credit balance, then that represents the balance of undrawn profits. That represents the balance of undrawn profits. If it's a debit balance, then that will represent drawings in excess of profits to which the partner was entitled. This is the format of the partner's current account. We'll credit it with the balance brought down if they are there. Interest on capital will be credited. Their profit shares will be credited. Their partners' salaries will be credited. Then the interest on drawings will be debited, and the drawings will also be debited. Then you come up with the balance carried down, which will appear in the income statement. So which will appear in the balance sheet. This is the partner's current accounts. So where the partners use the fixed capital account plus current account, then we expect to see different accounts. That is the current account and then the capital account. Then the other approach is the fluctuating capital accounts. Fluctuating capital, the fluctuating capital accounts. Now, in case the partners are using the fluctuating capital accounts, what does that mean? It means that they will be using one account, and it is in that account where they record each and everything. So that account will combine these two. These two accounts will be entered into, all the information, these two accounts will be entered into one account. That is if it's fluctuating. And it means that the balances will keep on changing year after year after year. That's why it's called fluctuating. And the capital account balance will be fluctuating. Okay? It will be fluctuating. Will be fluctuating. So always look at the question and see, are they using fluctuating or they are using the fixed capital and current account method. So they will always specify the method they are to use. Okay. Then, so this is the format of the current account. Now, what happens if there is no any partnership agreement? What happens if there is no any partnership? If there is no any partnership agreement? So where no partnership agreement exists, this is what happens. Where no partnership agreement exists, this is what happens. First of all, profits and losses are to be shared equally. So if you don't have any agreement, then we are shown that we are going to share profits and losses equally. There will be no interest allowed on capital. If there is no agreement, then there will be no interest allowed on. There will be no interest allowed on capital. How would you know the debit and credit side in the partnership account? Now, this is Richard. I think we are going to look at the questions, Richard, and you'll see how we do the accounts. No interest is to be charged on drawings. Salaries will not be allowed. So these are some of the this is what will happen whenever no partnership agreement exists, then we have to follow this. Balance sheet of the partnership. For the partnership, the capital part of the balance sheet will appear. So in the balance sheet, you have to present the capital accounts. You show the capital accounts and then the partners with their balances. You have to show that. Then we also have to show the current accounts as well. You have to show the current accounts as well. If one of the current accounts are finished in debit, the figure will appear in brackets and the balances. The figure will appear in brackets and balances. So that's it all. Now what we are going to do, we are going to go through our illustration. We are going to go through our illustration. We are going now to see how do we come up with the appropriation account, how do we prepare those partners, current account and capital accounts. Now that's where we are heading. And I have a question here. I have a question here. This question, I've shared it in the group. I have shared the question in the group. You can take in that question paper I've shared. There is a question paper I've shared in the group. So we are going to do that number there in that question paper. We are going to do that number very fast in that question paper. I'm going to do that. But still on my YouTube channel, I have more tutorials there about partnership accounts. So you can use all the resources. Yeah, but let us try to go through this. Let us try to go through this question here very fast. Let us try to go through this. So we have been told that ASIO, ACHAM, and AMIRA are partnerships. And their audit firm is registered as AAA Associates. They are the audit firm, which is registered as AAA Associates. So ASIO, ACHAM, and AMIRA share profits in the ratio of 2 to 3 to 1. That is their profit or loss sharing ratio. So the ratio has been clearly stated here. That is their ratio. That is their ratio. That is their ratio, respectively. So we have the trial balance as at 31st December 2021. That is their trial balance. We have motor vehicles at cost. We have furniture at cost. We have the computers at cost. Accrued incomes at cost. For accrued incomes, we have all that. We have accrued incomes. We have accrued incomes. We have prepaid incomes. We have consultancy fee. We have rent expenses there. Utilities, salaries are also there. General expenses, we have them. And then accumulated depreciation of the assets as at 1st January 2021. Capital balances are there. Current balances are there. Now you see, when it comes to the current balances, ASIO has a credit, ACHAM has a debit credit, but AMIRA has a debit balance. Okay, AMIRA has a debit balance. Balance is in the debit column. There's a bank overdraft. We also have drawings. We also have drawings there. We also have drawings. For each of the partners. Then we have the total. Then we have some additional information. We have some additional information as well. As you can see, we have some additional info. We have some additional information. We have some additional info, some additional information. What is the additional information? According to the additional information, we have been told that utilities, shillings 150,000 remained outstanding. Utilities of that amount remained outstanding, while rent of shillings 500,000 was prepaid. So we have some prepaid expenses here and some approved expenses, as you can see. Consultancy fees, 6.8 million received from the client for the services rendered during the year was omitted completely from the bank statement. In addition, consultancy fees income provided before in the trial balance, includes 3 million received for the services to be rendered in the future. For the services to be rendered in the future. Then the effective 1st October 2021, all the partners received the salary. Effective 1st October 2021, all the partners received the salary. We have talked about salaries. Each month, this transaction was not effected in the books. This transaction was not effected in the books. So there is a salary. There are salaries which we have to record. Then they are telling us that it's the policy of the partnership business to depreciate non-current assets as follows. So non-current assets have to be depreciated. So we have the company's policy when it comes to computing depre, when it comes to computing the depreciation. We have the policy of the company when it comes to computing depre, when it comes to computing depreciation. This is the policy. Interest on capital is 2%, while on drawings is 15% per annum. It is the partnership policy to maintain 20% of the profit as unappropriated. Their policy to maintain 20% of the profits as unappropriated. The net profit for the year after appropriations, but before deducting the unappropriated profits, is shillings 4,490,000. Now, when you look at this question, the profits have already been appropriated. Net profit for the year after appropriations, but before deducting the unappropriated profits is shillings this. What are we required to do? Required to determine the profit to be shared and each partner's profit share, partner's capital and current accounts, then the statement of financial position. It's okay. Let us try to do this. Though we are not required to come up with an income statement, then appropriation, but I think I have some videos on my YouTube where you have to first prepare the income statement, and then after you appropriate, I'll share the links. Then you try to use those tutorials as well. They will help. So part A, on part A, we are required to determine the profits to be shared by the partners. So let us try to see how to do that. I've shared my screen. I want to do part A of the question. Part A, we are required to do what? Part A, we are required to, part A, we are required to do what? We are required to determine the profits to be shared and each partner's profit share. Determine the profits to be shared and each partner's profit share and each partner's profit share. This is part A, which we are going to answer. Okay, this is part A, which we are going to answer. So normally we come up with an income statement. We get our net profits. Then those net profits will be appropriated. But now in this question, the profits are already appropriated. So we're not going to prepare an income statement. But I'm going to share some tutorials where we first prepare the income statement and then we appropriate the profits. So we have shillings, 1,000. The amounts are in shillings, 1,000. The amounts are in shillings, 1,000. So this is what you do. What we are going to do. I've told you the profits are already appropriated. So we have our net profit for the year. In brackets, I can say appropriated profits. appropriated profits. These profits for the year are already appropriated. How much are the profits for the year that were appropriated already? Take the additional information. There is a note about the appropriated profit. How much are those profits? Someone read for us the figure of the appropriated profits. How much are the profits appropriated? Yvonne, how much are the profits appropriated? Members, how much is the profit appropriated? Take the additional information. The profit figure is already given for the appropriated profit. Check the question I've shared. Check the question I've shared. Annette, how much are the profits appropriated in the additional information?
4,490,000.
So 4,490. That is the profit that is already given. The profits have been appropriated. But then it's the company's policy. It's the company's policy to appropriate the profit. Sorry, it's the company's policy to maintain 20% of the profits. So profits appropriated, these are profits that are going to be shared among the partners. And these partners have a policy to maintain like a 20%. 20% of these profits is not going to be shared. Okay? So we have to list the unappropriated profits. There is a profit which they are not going to go at. There is a profit that they are going to maintain. If the policy of the partnership is policy to maintain 20% of the profit as unappropriated. So out of the appropriate profit, we are going to remove 20%, and that one is going to appear as an appropriate profit in their account. They retain that, it's not given out. So unappropriated, it's their policy to maintain like 20% of the profits as unappropriated profit. So this one will not be shared to remain in the books. And this is 20% of the profit. It's going to be retained. So we need 20% times this. That profit is going to be maintained. It's not going to be shared. So meaning that I'll get this minus this. And what we get now are the profits. The profit to be shared. That will be the profit to be. That will be the profit to be shared. That will be the profit to be shared. But we have been told that we should also show the profit shares. So each partner's profit share, let's see each partner's profit share. Each partner's profit share. Each partner's profit share. Each partner's profit share. Who are the partners? We have a CEO. We have a CHAM. And then you also have Amira. What is their ratio of sharing profits? What is their ratio of sharing profits? What is the profit sharing ratio? What is the profit sharing ratio?
2 to 3 to 1.
2 to 3 to 1. So what is the total? What is 2 plus 3 plus 1? That is 6. It will be 2 over 6. Then times the amount which we want them to share. That is 3,592,000. Then a CHAM gets 3 over 6 times 3,592. That's what we want them to share. So Amira, that is 1 over 6 times 3,592,000. Let us get their shares. Is 2 over 6 times this. That gives us that. Then this is 3/6. We are going to round off times this. Then this is 1/6 times this, which gives us that. Let me just round off. Let me just round off to 0 decimal places. So that's it. Of course, when we add these shares, they should give us the other total amount plus this, plus that. So that is the profit share. The profits to be shared are these. It was just a matter of getting the this was less unappropriated profit, not 20%. Less unappropriated profits. That was 20%. Then you get this. These are profits to be shared. Then after you show the shares according to the ratios of the partnerships. According to the ratio of the partners, how they share their profits. Okay, so that is part A of that question. Though something a question where you are supposed to come up with the income statement and then appropriate profits would have been better, but that's what we have for now. Let us just continue with this and now answer the rest of the parts. Part B is asking for what? Members, part B is asking for what? Let us do part B. Part B is asking for what?
Partners capital and current account.
Let us prepare the partners capital and current accounts. I've talked about those accounts that if they're using the fixed capital plus current account, then they will be prepared into different accounts. So let us try to prepare those accounts. This is partners capital and current accounts. Partners capital and current what? And current accounts. This is what we want to come up with: partners capital and current accounts. Partners capital and current what? And current accounts. Partners capital, current accounts. I'm going to start with the capital account. I'll start with the partners capital account. So partners capital account. This partners capital account records capital strictly only. They only enter the capital balance only in that account. We use it to record only the capital. We use it to record only the capital account. We use it to record only the capital on the capital account. So partners capital account. This account, you have to show the details. Details. We have to show the partners, that is ASIO. So we have ASIO, we have ACHAM, and then we have AMIRA. Then details on the other side of the account, details, ASIO, ACHAM, and AMIRA. So let me just make this here now. Let me try to increase on the width of the accounts, of the columns rather. So this is your account, NAS capital account. I think now it's clear. Yeah. Now it's this is how we prepare that account. Told you the account is used for capital. You use it to record the capital balances of the partners. So capital, the capital account has a normal credit balance. You get the balances brought down. You enter them in the accounts of the partners. So details, balance, wrote down the capital account balances of these partners. That's what you should put here. Balance brought down, debit. I think I need to put shillings and thousands because there is a rounding involved. Shillings and thousands. Shillings and thousands. Shillings and thousands. You have to show that also. So let's now I broke down the capital balance of ASIO. Look at the trial balance. How much is the capital account balance of ASIO? Someone to take and read those values very fast. How much are the capital account balances? Look at the trial balance.
Did 50?
For ASIO, it's
2000.
50. Then Acham,
60.
6,000.
Acham it's 60. Then Amira,
40,000.
Amira it's 40,000. That is capital. Now, unless the partners have contributed more capital, unless they have contributed more capital into the partnership, if there is no any other capital that has been added, then these balances are going to appear for all the years the partnership is going to be in existence, unless the partners have added more. That's why we call it fixed capital. So the capital balance is maintained year after year. So balance, get your balance carried down, which will still be the same balances because there is nothing we have added. There is nothing we have added. So those will still be the balances in this account. Excuse me. And then here I'm trying to balance. You know what balancing means? Just inserting the balancing figure, the smaller side. So balance up. Balance up. This is the capital account. Then at the start of the next financial period, there will be a balance brought down, which will still be 50K for ASIO, 60 for Acham, and then 40 for Amira. That is the capital balance, the capital account balance. Those are the capital account balances, and that is your capital account. That's the partner's capital account. That's how we prepare. But it strictly records only the capital contributions of the partners, only the capital contribution of the partners. Which other account do you want us to prepare? The current account balance. Let us also prepare that. Let us also prepare the partner's current account balance. Let us prepare the partner's current account. So this is partner's current account balance. This was capital. This was our capital account balance. Now I want to prepare the partner's current account account balance. Partners current account balance. So you remove, let me remove these, because now this is current. This is partners current. Partners current account. Partners current account. Now the current account records, what does it record? The current account records, we use it to record transactions that affect the partner's equity, but not considered part of their capital. So we use it to record those transactions that are going to affect their equity, but not considered as part of their capital. For example, we use this account to record drawings. We use this account to record interest on drawings. We use this account to record interest on capital, to record their profit shares, to record their allowances. All those are going to be entered in this account. Current account. Capital account is strictly for capital, as I've told you initially. Okay. So you will start with the current account balances. Look at the balance. Look at the total balance. Look at the total balance. How much is the current account of ASIO? Those balances are there in the question. Those balances are there in the question. How much is the balance of ASIO? Current account balances.
2,600.
Here we have 2,600. So you enter 2,600. Then ACIAM.
1,200.
1,200, that is ACIAM. Then Amira.
16,500.
Amira is 16,500. Those are the balances. No, for Amira, one of them has a debit balance. Sorry, I think that is Amira, right?
Yes.
So balance brought down for Amira, that is on the debit. So you take it to the debit. That is how much? 16,500.
Yes.
So you always have to look at their balances. If the balance is in brackets, then that will mean that it's the debit balance. So Amira has a debit balance. So those are the opening balances of the current account. Increase this account. If it was a loss, profits, we have some profit shares here. The profit share of ASIO was 1,197,000. Then for ACIAM, it was 1,796,000. And then for Amira, it's 599,000. Amira, those are the profit shares. Then we have to get the salary. Their salary, partners' salary, because we saw somewhere these partners are getting a salary. So the salary will be credited in the current account. The salaries will be credited in the current account. Let us check and see the salary. That is not what? That is note 3. Let us look at note 3. Let us all look at note 3. Let us look at note 3. Note 3, we have been told that effective on 1st October 2021, effective on 1st October 2021, all partners received the salary. There is the message here. What is the normal balance of the partner's current account? Credit. The normal balance of partner's current account, that account should be having a credit balance. Should be having a credit balance. That's why you see that the partners with their credit balances, we have entered them on the credit. But If it's a debit, then you put on the debit balance. So that means that that partner has a negative balance. They have a negative balance, so you debit it. But the normal balance is credit for the current account. So effective on 1st October 2021, all the partners received a salary of Shillings 100,000 each per month. This transaction was not effected in the books. This transaction was not effected in the books. So we have to find out the salaries so far. When are they reporting? They're reporting on 31st December 2021. 31st December 2021. And they're telling us that effective 1st October. So this is that we have to get salaries for October, November, and December. That is a period of 3 months. October, November, and December, because we are closing on 31st December. We need salaries of 3 months. These salaries should be credited in their current account. So meaning that I'll get just 150K times 3 months, and that will give us 450K. Even here. So your salary is 450K. I've told you, they have said that from effective 1st October, they are entitled to a salary of 100,000 each, and they are reporting on 31st December. Those salaries have not been recorded anywhere. So we have to get the cumulative salaries from 1st October to 31st December. So that will be that will appear on the credit. The other item that appears on the credit is the interest on capital. Interest on capital. We have to get the interest on. We have to get the interest on capital. Someone read for us note. Someone read for us note 5. Who can read for us note 5 of the question? Note 5. Someone read note 5 of the question.
Interest on capital is 2%, while on drawings is 15% per annum.
Interest on capital is 2%.
2%.
While interest on drawings is 15%.
It's 15%.
So we have to calculate the interest on capital. They have told us that it's 2%. 2% of their capital balances. So our CEO's capital was 50. That will give us 1,000. Then 2% of Achami's capital, the interest on capital. Achami's capital was how much? It was 60. That is 1,200. Then 2% of the capital of Amira, that was 40, giving us 800. That is the interest on capital. Interest on capital should be credited in the partner's current account. Because I told that they have to get some interest on the capital they have invested, so that is like an income. It's an addition to their current account. Then on the debit, what do we put on the debit? On the debit, these partners are going to withdraw money. So the drawings are to be debited the partner's current account. The drawings are to be debited. Let us see the drawings. Let us try to look at the drawings. Let us look at the drawings. How much are they withdrawing? Someone read for us. Which note is that? Drawings. Drawing. Which note is that about the drawing? So we have the drawings in the trial balance. We have the drawings in the trial balance. Just read for me the drawings from the trial balance. How much are the drawings of Asio, Acham, and Amira? We have drawings. How much are these drawings? Someone read for me the drawings very fast. We enter them.
12,000.
That is who? ACOA.
Yes.
ACOA is 12. Then Acham,
11,600.
11,600. That's Acham. Then Amira.
13,000.
Amira is 13,000. Those are the drawings. Then we still have to debit this account with the interest on drawings. Interest on drawings. Interest on drawings. What rate do they charge on the interest on drawings?
15%. Sorry,
What rate do they charge on the interest on drawings?
15 per annum.
15%. 15%
Yes.
per annum. You get their you calculate their interest. You get 10% times their drawings. So this gives us 1,800. That is 1.8. 15% times the drawings of Acham. And then 15% times the drawings of Amira, giving us that. These are the drawings. Now what we have to do next is to balance this account. These are the entries you make in the current account. The credit side, we see the balance breakdowns, the profit shares, the partner's salary, and then the interest on capital. Then on the debit, that's where we have the drawings and the interest on draw and the interest on drawings. Okay, so that's what we have. Let's balance up this account and we get the balancing figure. That is the balance brought down. That is the balance carried down. So let's try to do the addition and receipt. But when we try to look at this current account, all these partners have taken more money from the partnership business. Like they have taken more money from the partnership business. They have withdrew more than what they had on their account. Look at their drawings. Look at the drawings. They are taking more money from the business. So their balances are going to be debit balances according to what we have. Their balances are debit balances. Yeah, let us balance because the debit side is greater than the credit. We try to look at this. So it means that the balance carried down is going to be on the credit because we see they are taking more money from the business. So their balances are negatives according to this account. That's what we have. So even this side, we should be having the same balances. Remember, when you balance an account, the totals should be on the same side. So we are going to insert the balancing figure. This will be this, minus this, minus this, minus this, and minus that, giving us 8,553. Then Acham, we get this total minus this, minus this, minus this, minus this, giving us that. Then Amira, this, minus this, minus, giving us. So that is the current account. And that is our current account. So these balances are debit balances. So they are negatives. Balance brought down. For ACO, it is this. For Acham, it's that. And for Amira, that. So that is the current account for you. That is the partner's current account for you. So I think we can do the balance sheet. Then we'll go when this we finish when this question is complete, such that next time we can look at something else. Maybe we can look at changes in the partnerships. We can look at changes in the partnership, admission of new partners, changes in sharing ratios. We can do that. So that's it. Now let us do the balance sheet very fast, and then we call it a Saturday. Our session should be ending at 8, but I think we can do the balance sheet and then we complete the full question. Such that next time when we meet, we look at something else. How do you see? Let us do the balance sheet very fast. So this is part C. This is part C. Part C. So we want to come up with a statement of financial position. Statement of financial position. You should know how to prepare a statement of financial position. He told you that there is no any accounting exam where you will not prepare the statement of financial position or the statement of profit or loss. Those are things which you should be knowing by now. How to come up with a statement of profit or loss, how to prepare the statement of financial position. Those ones I must know. You need to know them. Those ones I must know. So let us write the heading. This is our CO, our charm, and our mirror. And our mirror. Statement of financial position as at 31st December 2021. So we want to come up with this position. Sometimes you can call it the balance sheet. Yep, so that's what we show the column for cost, because as less accumulated depreciation, and then NBV, what we call the net book, value. Let us do that statement very fast. Then we call it a day. Okay, so we start with our assets. That would be the first heading, assets. So we try to show the assets first, and other assets we start with non-current assets. Non-current assets. Other non-current assets, what do we have? Someone check the trial balance, get for us the non-current assets. We list them here very fast. Non-current assets. Members, please let us do this and finish. Non-current assets, what do we have? Yvonne, what are the non-current assets? Annette, what are the non-current assets?
We have furniture, motor vehicle. We have furniture at cost, which is 12,000.
Furniture is 12,000 at cost. Okay. Then what else do we have?
Motor vehicle at cost, which is 120.
Motor vehicles, 120.
And then we have
What else?
computers at cost, which is
Computers,
24,000.
which is 24,000. Those are the non-current assets. These are their positive values. I told you should know how to prepare a statement of financial position, because when you look at all the accounting papers, you have to prepare these statements. Profit and loss, balance sheet, you prepare them. These are obvious. You expect to see them. Amounts are shillings and thousands. Shillings and thousands. Shillings, thousands. Now we are going to look at the depreciation of these assets. Depreciation. Remember, non-current assets depreciate. So we have to get their depreciation. And this is accumulated depreciation. Accumulated depreciation. Accumulated depreciation. So we are going to compare the accumulated depreciation. Let's first look at the question and see what we have there. It's the policy of the partnership business to depreciate non-current assets as follows. Non-current asset depreciation rate per annum method, and then you also have some accumulated depreciation as at the start. I think let me just come up with the working for this. Better, let me just come up with the working for depreciation here. It will make sense that we don't do the working from our statement there. So accumulated depreciation at 31st December 2021. Let me just compute from here. Hope my working is clear for the depreciation. Let me compute from somewhere here. Do you see the working for depreciation, where I'm doing the depreciation from? Remember, is the working for accumulated depreciation clear? You see this? I just want to come up with a working, then we just take the final figures. Charge for the year, and then balance at end. Let's compute it from here. This is shillings, thousands. Shillings and thousands. And this is thousands. Just compute it from here. Very fast. Okay, what are the assets we have? You said we have motor vehicles. What else, Yvonne, do we have? Motor vehicles, then what else?
We have furniture. And then computers.
Can you read for me the depreciation? Depreciation at the one of the
For the motor vehicles, it is 30,000.
the accumulated depreciation from the question, from the trial balance. Okay.
Yes, please.
This is 30. Then furniture.
1,800.
1,800, that's furniture. Then the computers.
4,800.
4,800. Now we are going to get the depreciation. That one we are going to calculate using the company's policy. We are going to calculate using the company's policy. So check the policy of the company. That is not one. Not four. How do they calculate depreciation? As by the policy of the company. What is the depreciation rate? What is the depreciation rate? Let us compute that.
25%.
This is 25%.
25%.
Straight line. Straight line, it means that you compute the depreciation using the cost of the asset. What is the cost of what's the cost of the motor vehicles? How much is the cost of the motor vehicles? That is 120,000. That gives you 30. So meaning that this will be this plus at their end. Then for the furniture, how do they calculate depreciation for the furniture? What is the rate for furniture? 15%.
Yes,
10% times the cost of furniture. What's the cost of the furniture? This is cost straight line.
12,000.
Cost of furniture is 12,000, which gives you 1,800. So that will be 3,600. Then the computers, what's the rate?
20%.
Times the cost, which is how much?
24,000.
24, giving you 9,600. So these are the depreciation figures. At the end of the year, this is our depreciation balance, accumulated depreciation balance, carried down. These are the figures I'm going to take to the balance sheet. Accumulated depreciation for furniture. It is this. Then for the motor vehicles, it's that. You add the balances brought down, then you add the depreciation charges for the year to get your accumulated depreciation as at the end of the year. Net book value is the cost less the accumulated depreciation. Net book value is cost less accumulated depreciation, less the accumulated depreciation. So meaning that our net book value will be the cost less the accumulated depreciation, which gives you 82,800. So those are the non-current assets. Currently at cost, less accumulated depreciation, less accumulated depreciation. Currently at cost, less accumulated depreciation, less accumulated depreciation. We move to the current assets now. Let's move to the current assets. Let's move to the current assets. Remember, current assets, we expect to convert these current assets into cash. We expect to convert them into cash within just a period of 12 months. So under the current assets, of course, we have items like inventory. That is the closing inventory. So do we have closing inventory in the question? I didn't see closing inventory. Didn't see this. They didn't talk about the closing inventory. Oh, remember this is an audit firm. Sorry, this is an audit firm. So we don't have inventories. So let me ignore this. Inventory we don't have. What do we have now? What do we have? Do they have any prepayments?
We have rent, prepaid rent.
Oh, we have prepaid rent. Utilities remain outstanding and while prepaid rent was 500. Okay. We have some prepayments. Okay. You always have to look at the nature of the business because now this is an audit firm. So don't expect to see things like inventory purchases. Don't expect to see those. So prepayment, we have prepayment for rent. That is 500,000. The 3 zeros are up. We are rounding off. Then still we have accrued income. Is it accrued income? There is something about accrued income. Accrued income, those are current assets of the business. Income that has been earned but not yet received. We have accrued income. That is the 42,500. Accrued income from the trial balance. Accrued income is income that has been earned but not yet received, so it's a current asset. Okay, so we have accrued income. Accrued income, that is 42,500. Accrued income, they are current assets. Then we have cash and bank. Cash and bank, we have cash and bank. Do we have cash and bank, cash and bank, cash and bank?
What about the consultancy fees received in the additional information? Is it an income?
Let
An
us
asset?
check. Consultants fees shilling 6.8 received from the client for the services rendered during the year was completed from the bank statement. This is income. We are going to just add it to our bank because it was received, but they have not recorded that anywhere. Then in addition, consultants fees income provided in the trial balance includes the 3 million received for the services to be rendered in the future. Okay, we are going to see how to do this. Let us bring our cash and the bank. Do we have cash? Oh, it's bank. What do we have? Initially, it was a bank overdraft, I think. There is a bank overdraft down there of 1,200. The bank overdraft. So because there is some money they are receiving, to no longer be a bank overdraft at the end. So I'll say bank. So I'll get the overdraft of 1,200. The bank overdraft is liability 1,200. But there is some income. There is some income that was omitted from the consultancy fees received, but they are omitted on the bank statement. How much are the consultancy fees received? Because they have said 6.8 million received from the client for the services rendered during the year was omitted completely from the books. So meaning that we have to increase, we have to add that consultancy fee. Our bank balance, that is 6.8. So we have to show that. We have to show that 6.8. So we have to add it. So now it no longer be a bank overdraft because of the 6.8 that was ignored. So we have to show this. So meaning that this will be negative 1,400 plus the 6,800. So now our bank balance will be, sorry, I think it should be the 6,800, which is positive, minus the overdraft of 1,200. This will give you 5,600 as the bank balance now. 5,600. Initially, it was an overdraft, but there is some money that we had received, but it was not considered, it was not recorded anywhere. So now the balance will positive 5,600. These are the current assets. What you can do, you can add them. We don't have receivables. We don't have receivables. In this case, like the accrued income services we are provided, we earn the income, but it has not yet been received. So you add this with this, you get 48,600, which is going to be added to your total current, non-current assets up here. Get total assets, which is non-current plus the current. Yvonne, you have a question?
I'm inquiring about the 3 million. How are we going to treat it under the consultancy fees?
We are going to adjust the prepayments, because when you try to look at that note, let me share a screen here. In addition, consultancy fees income provided the trial balance. Consultancy fees income provided the trial balance includes 3 million received for services to be rendered in the future. So 3 million is a prepayment. This is a prepayment. Income received in advance. So it's a prepayment. But remember, in the trial balance, there is prepaid income somewhere. So we are going to adjust the prepaid incomes by adding an extra 3M. Okay. This is a prepayment. In addition, the consultancy fees income provided in the trial balance includes the one in the trial balance, not this 6.8, includes the 3 million for the services to be rendered in the future. This is a prepayment. This is a prepayment. Let me just add a note here. This is a prepayment, prepaid income. This is a prepaid income, and it's a liability to the business.
Yeah, liability.
This is the current liability. So we are going to start with that when it comes to the liabilities. So total assets, figure total assets. So this is your total assets figure. That is your total assets figure. So from total assets, now we go to equity and liabilities. Equity and liabilities. We move to the equity and liabilities. Under equity, of course, you bring your capital accounts. You bring the capital account balances for these partners. You bring their capital accounts. So in the balance sheet, you have to show the capital accounts of the partners. So we have a CO. We have a CO. Have a CO. We have a CHAM. And then we also have a mirror. Read for me their capital account balances very fast. The capital account balances, we have them from our capital account. Our CO is 50. A CHAM is how much? 60. And then a mirror is
40.
40. Making it a total of how much? Making it a total of this plus this, making it 150,000. That's our total capital account balance. Total account balances for the partners. Then you bring your current account as well. We bring the current account balances as well. Current accounts. However, these partners, their current accounts are negative. The current account has debit balances. It means that they withdrew more than the profit they had on their account. So their balances are negative, so we are going to show them as negatives because they appear the debit side of the current account, yet they're supposed to be on the current on the credit side. So if they're the credit side, then they would be positive. They have some money, but now the balances are on the debit, so the balances are negative. So a CO, don't forget to show them as negatives, a charm, and then a mirror. So a CO, negative what? 8553. 8553. Then 8694. 8694. Then mirror is 29601. So this should be in brackets. Should be in brackets. So let me try to add them together. That's what I have, 46848, but negative. Then we have the unappropriated profits. There's a property that is to be maintained, the profits that are retained, unappropriated profits. The 20% which we computed, that one should appear. It's going to be retained in the books. That was 898. That one is there. So now we can get the total equity. Total equity. Let us try to get the total equity. That will be the capital plus the current account balance plus the unappropriated profits, giving you 104,052. Then we can go to the current liabilities, because I didn't see any current liability. Current liabilities. Under current liabilities, I saw we have current liabilities. What do we have? I see we have, first of all, we have the accrued
Prepaid income.
Let me first put the utilities. We have some accruals, some accrued expenses. The accrued expenses. So accrued expenses, those are current liabilities. So accrued utilities are how much? 150,000. This is 150. Then we have the prepayments, that is prepaid incomes. So prepaid incomes, those will appear under the prepayments. And in the trial balance, there is a prepaid income of how much in the trial balance? Take the prepaid income of the trial balance. It's how much? How much?
$24,500.
The one in the trial balance is how much? Prepaid income?
24,500. Sorry, 22.
24.
22. Sorry, 42,500.
It's 24,200 prepaid income. Prepaid income is 24,200. That was income that was received in advance. It's a current liability. The income received in advance, prepaid income. That's it. Current liability. So 24,200. Then there is some consultation fees that was received, but belonging to the future. It belongs to the future. So that one should appear under the current liability. So I'll just add the 3M here. I'll add the 3M. So meaning that our prepaid incomes or our prepayments will be the 24,200 plus the 3,000, making it 27. What? Making it 2700. making it 27.
In the warehouse, that's 3,000.
Trial balance.
Okay.
So when you add these 2 plus this, we get 27,350. So this 27,350, we add this plus our total equity, and it will give us 131,400, and this will be total equity and liabilities. So equity and liabilities. Total equity and liabilities. So this is our statement of financial position. This is our statement of financial position. This is our statement of financial position for that question we have. Which we have. So you see, this is a statement of financial position for a CEO, a charm, and a mirror. So this is part A. This is part B of the current account and the capital accounts, and then the statement of financial, then the statement of. In case you want to refer to this question, there is a tutorial on my YouTube. The class has been recorded there. It's already there because others were watching from YouTube. So you can refer to the recording anytime in case you need it. It will be there. So we are.